Hey guys and girls, welcome to this week's episode of the No BS With Birchy podcast. I'm your host, Nathan Birch. This is a show unraveling the truth to the facade of the 21st century. We're now exiting the matrix and waking up to motherfucking reality. The intro never gets old, folks. The intro never gets old. And some fundamentals never get old. And today we're going to be talking about capital growth versus cash flow and yield. So, I guess, balancing the difference. Can you get both? I always see people talking about, well, if you're going to have capital growth, then you're not going to have cash flow. And if you're going to have cash flow, you're not going to have capital growth. And, I think it's just a old, belief system, which means that you can't have it. And, I guess in the world that we're looking in today, buying properties that are, 200 grand do seem like a thing of the past. Buying properties that give you 10% yields do seem like things of the past. But they are out there and they have always been hard to get. And, for a lot of people saying, Birch, you're talking about a property you bought for someone 5 years ago, 10 years ago at 200 grand rent for $300 a week or renting for $600 a week. Those properties were 200 grand renting for $300 a week. They went $500,000. They rent for $600 a week. Those sort of things. That's taken years to get there. But when we're looking at the fundamentals, I see no difference between the market today and the numbers that we're looking at compared to something 10 years ago. If anything, the yields and the cash flows are probably better in 2024 than what they would have been in 2014, and certainly 1,000% better than what the yields were back in 2004. So if we go back to 2003, buying my first property and thinking about the yields that I could find out there, interest rates were like 9%, right? Purchase price was like 300 grand in Sydney. And rental returns were $200, $250 a week. So everything was negative cash flow that you would see. But it was trying to find the least negative cash flow. It was trying to find the stuff with the greatest growth potential, with the greatest cash flow potential. And, hindsight's a wonderful thing. And it's easy for people to point back and say, oh, it can't happen to me, or I can't make this happen. But if I look back throughout every year from the last 2 decades of investing and helping other people invest, I actually think that some of the cash flow deals that I bought for my investors have way outperformed, from a capital growth perspective, some of the greatest and best renowned suburbs of Sydney. So we'll jump into it today and break it down and let's have a deep dive into capital growth, cash flow, or can you get both? And I kind of always feel like when I tell people that you can have both, I feel like that taco ad. I don't remember the exact parts of the taco ad, but it was like probably shouldn't do singing, but if we remember, there was the kid that said you can have the taco that stands up, and you can have a soft shell taco and a hard shell taco, right? Why don't you have both? And as an investor, I think you should have both. If you don't have both, you're screwing yourself up, and it's you're going to be hurting yourself getting to your goal in one way, shape, or form. So what is the difference between the capital growth and the cash flow? I guess the first thing, some people come to me and they say, I just want to buy things with good capital growth. Well, everything's going to have good capital growth. Define to me what is good capital growth as a first thing. And more so than ever, I get more people come to me and say, Nathan, I want to have neutral or positive cash flow properties. I only care about the cash flow. Well, if you only care about the cash flow, you can get there's some properties out there that cash flow tremendously, right? But I wouldn't touch them because you'd be impacting your capital growth. So you need to have the good balance of both growth and cash flow in your portfolio. So what is important and what should you go for? I just said you need both, but most importantly, what do you need in your portfolio, right? And I think once you start taking a look back and going, what do I need? And then you can start acquiring in line with what you need to get you to where you want to be. So how I'll break it down is like, I have people coming to me, and I'll just make up some scenarios here and rough stories. I have people come to me, they might be on, 300 grand a year income, and they've got $0 saved. And it's like, hang on a second, you got $0 saved. Like, obviously there's an issue with, lots of income, but lots of expenses as well. So, that person might be better off going out to get something that's got really good equity to push themselves forward. Someone might be on $30,000 a year and they might have $100,000. That person will need to be more cash flow based, right? But I recently had someone on the podcast. We had Josh on, and we were talking about some of the properties, and it just came to mind some of the properties that we were discussing with Josh that he'd bought in his portfolio. And one of them was like $85,000, now worth over $200,000 and renting for $300 a week. Another one that he bought last year for $160,000, it's worth $300,000, renting for $400 a week. You know, if we go back to Sydney and look at some of the most prestigious areas of Sydney or the most best areas of any booming city, you wouldn't have seen those sort of growth numbers. So, just to go to and look back, they are out there. There is the possibility to get both positive cash flow or neutral cash flow, a strong cash flow, and capital growth at the same time. So where are you in your journey? Probably the first question, right? Are you more, how much capital do you have in your portfolio? Do you have 50K? Do you have 20K? Do you have 100K? Do you have $500,000? Where do you sit there? What is your lending perspective? What is the bank going to lend for your portfolio for you to be able to, can you only get $100,000 loan? Can you get $1 million loan? These are very important questions you need to be asking yourself before you set out and go, okay, this is the type of property I need. And some properties I get are by nature more positive cash flow than others, but I wouldn't go to say it's crazy one would outperform the other as long as they're fairly neutral. Because if we look back, and I look at like thousands of properties, right? We manage at Blink Property, which is my property management firm, like thousands and thousands of properties in all different corners of the country. And I look back at those properties and I think, some of these things have risen $200 in the last 12 months. So if that property was neutral cash flow last year, this year it's positive $200. Some properties only got $50 a week. So, what it's renting for today isn't a determination of what it is going to be like in the future as well. And you need to sort of factor those things in. So as an investor, we need to sit back and think, what are the goals? What does it look like? And most importantly, what does my bank need from me? And, as an investor, when I first started investing in the property, I thought houses was the only thing that would make money. Everyone told me, units, villas, townhouses, strata, you don't want to get involved with it, those sort of things. And I got stuck at about 7 properties, and they were only houses at the time. And then I bought a townhouse one day, and I realized my servicing increased. And I was like, hang on a second, I bought a second townhouse, and then it increased even further. And I realized at that point, it was a very crucial point in my investing journey, that it wasn't about what I wanted as an individual, because that was my emotion, it was my belief system, it was my thoughts, it was what stories other people had told me, but it wasn't what the bank needed. And I had a gatekeeper, and each step on a journey I saw in the early days, or see still to this day, there's always some sort of obstacle that you have to overcome. And once you overcome it, then you can go for the bolt to the next obstacle to overcome. And I realized at a very early point that it wasn't what I wanted. It was what the bank required from me to be able to give me more money. So if you're sitting there as an investor, I'd say out of the investors that come to me, there might be half of our investors have property to start off with, half of them have no property to start off with. Out of the ones that do have a property, probably half of them are sort of stuck at some point, and I have to go through their portfolio and go, what caused the conversation for us to have today where they've come to me and they're like, I can't buy any more property, I can't get a loan, this can't happen, that can't happen. And I really have to go through and go, well, what has caused that? And 9 times out of 10, it's because the asset hasn't been purchased or acquired in order to open up financing. It's been, every acquisition's been closing the doors to finance and taking options off the table for you. And as an investor, you need to be thinking, how's this property going to, get me to the next step? So if we're looking at a cash flow property, it can be good, but let's say you're, an 18-year-old kid starting, you've got $40,000 saved up as a deposit, and your income's $50,000 a year, and it's going to take you another 2 years to save up a deposit. Should your property be that you're trying to get $50 per week positive cash flow? Yeah, $50 a week's cool, but $50 is only $2,500 a year, right? You could buy a property that's neutral cash flow today, or maybe cost you $20 per week out of your pocket, and it'd still be roughly in the same vicinity. The problem is that how long is it going to take you to get that next deal by having to save that $2,000 a year? If you were to buy a property that had a big chunk of inbuilt equity into that deal, then you could pull out the equity after a month or 2 months or 3 months or 6 months, however long it takes, pull the equity out, and there's a deposit for the second property, and then be able to rinse and repeat that process to get to where you need to be. I think also looking at your end goals, right? We quite often talk about, what is the big picture, where we're trying to go to. I quite often see investors, when they're buying a property, they're thinking 6 months, 12 months, how are we going to get the equity, how are we going to get the cash flow, whatever, but not thinking this is an asset that I'm going to carry for the next 5 years or 10 years or 15 years or 20 years. How are you going to dispose of that asset? Are you going to keep this property forever? Is it going to be a property that you're going to dispose of in 10 or 15 or 20 years? I was talking to someone the other day about their portfolio, and it was a discussion from a strategy side of things. And I don't want to go too far into it because, everyone's position is different and, should be treated so. But someone overheard me talking about, this person asked me about a super fund, and I don't give financial advice about super funds and stuff like that. But it was a discussion in general form about, this person wanted to buy like 10 properties in their personal name, and then the view is for the next 15 years, 20 years, buy the properties in their super, and they might get 4 properties in their super. And then their goal, because the super fund is a tax vehicle, they'd spoken to their accountant, they realised it was a tax vehicle, to sell down those 4 properties. So if they bought 4 properties at 200 grand a piece, for example, there's 800 grand with 250 grand worth of starting capital. Those properties go from 800 to 1.6 to 2.4 million. Over 20 years, they pay down that debt. They can sell those properties and take the profit and pay down the debt in their personal name. So if that was a strategy that someone was thinking of doing, then from that strategy, those properties that they're buying would need to be more geared towards, hey, this thing here should be, we need the capital growth out of this because it's got a simple purpose of, paying down some debt over here. So you need to be thinking, why am I acquiring this asset? How is this asset going to help me in the long term? Most importantly, like some of these properties that I buy, if it's $50 a week positive, $50 a week negative, I still call it fairly neutral because, it's neither here or there, right? It ain't going to change your life. If you put the rent up on a negative $50 a week property by $200 in the next year, well, then it comes $150 positive. You won't be remembering the year that it was negative $50. So I don't like negative geared. I don't buy properties for negative gearing. I don't buy them for tax deductions. And when I say, positive 50 or negative 50, I'm talking about after council rates, strata fees, land tax, council rates, insurances, all those sort of costs, interest. You want it to be neutral after that. And I don't factor in any sort of, tax deductions, depreciation. That's all just a bonus that you get on the top of it as well. So as long as the property is fairly neutral, you need to think about how's it going to fit in the portfolio. Is it going to be something you're going to carry forever? And sometimes with the properties that I buy for my investors, I'm like, hey, there's something happening here. This property, I see a risk in holding it if you hold it for 20 years. If that thing goes up 5 times in the next 2 years, it might be best to sell that property and take those profits and either pay down debt on other part of your portfolio or use that to acquire more assets. So, I see people that go in and they're only looking for a property that's positive $50 a week. And if they're only looking for a property that's positive $50 a week, that's their prime reason for making that decision. Or they're only going to buy the property because it's in a specific type of location and they're happy for it to be $250 per week negative, right? And I don't participate in helping people hurt themselves, so I wouldn't be suggesting stuff like that for people to buy. But people go along their day and make decisions and all that sort of stuff, but don't give it too much thought about how's it going to affect me 2 or 3 steps down the track. So I think it's very important to understand the fundamentals of the deal. What are things that would cause capital gains to occur on a property or rent increases to turn something positive cash flow in a property? Most people think a capital city is a good thing, right? If it's a capital city, I remember when I was buying 50 properties a month in the Gold Coast for our investors, this was a few years ago, and people like Gold Coast is never going to go up in value. Well, I just pulled out a deal. I might actually get the team to put a photo of this one up on the screen, right? Just for the fun of it, right? So just here's a little photo if you're watching on the video. With this property here that's on the screen, This thing here, we paid in the same complex for 150, 160, 170 bucks per week. They're now selling for $600,000 in the Gold Coast, right? Now it's a hot place, but 5 years, 10 years ago, people were like spitting on the Gold Coast saying this is a bad market, et cetera, et cetera. So the belief system of something that's occurred in the past, right? This property will have capital growth, this one won't have it, doesn't stay true, right? If we look at the Gold Coast, things have doubled, tripled, quadrupled in 5 years. If we look at Perth, things have doubled, things have tripled. People think it's the hottest thing ever to go and buy in Perth at the moment. Is Perth the right thing to buy? There's some good properties in Perth to buy. But does that mean that they're all going to double in the next 2 years or 5 years or 10 years? I remember 10 years when they went backwards. Everyone thinks Sydney's a good property market to be buying. And I remember times in Sydney where over a decade, they went backwards in price. So what's happened in the past doesn't mean it's going to happen in the future, but the fundamentals are very, very important. Certain things have played into some of these markets. So if you are a migrant coming from China, coming from India, coming from England, coming from wherever, right? You're not from Australia, not from the Commonwealth. You're coming to this country. You might be a doctor, you might be a lawyer, you might be, highly educated. You've spent 5 years at university, right? When you arrive in Australia, you are no longer a doctor or a lawyer. You have to go and become a new doctor here in Australia or whatnot. There's certain incentives and initiatives from the government. I've never talked about this because this was my IP from years ago, but it's, these things have already occurred, right? Like these markets have taken off due to this, right? Skilled migrants coming to the country, if you become a doctor in the Gold Coast or Perth since 2019, you instantly, because you're going to a regional location, they define them as a regional location, you work there for 10 years, you automatically become a doctor by being in those locations or whatever skill that you're in, right? An engineer, so on. There's other areas which this is occurring at the moment, and we've seen massive influx of migration here, right? So that sort of stuff is driving potential capital growth to these locations. And they might not be your typical sort of properties. At the same time, I was buying properties 15 years ago for our clients in Mount Druitt for 150 grand. I was buying properties in Vaucluse. I bought a really nice property on the peninsula in Vaucluse. It was a block of units, $600,000 for 2 and 3 bedroom units in there. And that was a great purchase, right? People did very well out of it. Those things worth $1.5, $2 million now. But if we go back and think I was buying in Mount Druitt for 150 grand, it's worth 800, 900 grand. That's gone up like 5 times in Mount Druitt, right? And the rent was like $300 a week, now renting for $500 a week. So people would go, oh, Mount Druitt, that ain't going to grow up in value. But when we look at the hottest suburb of Sydney, Vaucluse, you go 600 grand to 1.2 to 1.8. It's probably not even 1.8 at the moment. But let's say it's doubled or tripled. Those things were renting for $400 a week. And then now they're probably $750, $800, $900 per week in rent on those properties. Now they're starting to go to positive cash flow, but it's taken them a decade for it to do that. Where the thing's been in Mount Druitt positive for a decade and gone up 5 times. So, what we need to be looking at, there's 2 fundamental things. I always say there's 3 things: below market value, strong cash flow, and good upside for growth. But if you're looking for the upside for growth, there's 2 key drivers that are there, right? One is that we need to make sure that the location you're buying in is going to have the people's income is able to service for the higher price, right? Let's just use the Hills District in Sydney, right? And you could probably look at the closest neighbourhood to wherever you're watching this and wherever you live, whether it's nationally or international. Let's say the Hills District, a house on land for $1.5 million with no eaves and a Colorbond ironstone colour roof, right? So a grey roof, no eaves, little 300 square metre block of land, $1.5 million. If someone's average income is 150 grand, 180 grand, double income, no kids in these locations, how is that property going to go up to $3 million from $1.5 to $3 million if the income wouldn't be able to support a loan at that? And at what point, an inflection point, would it allow that to happen? It might mean the interest rates at 7% today, you can't service for it. But if the interest rates went to 2%, well, then it could double up to $3 million. So for that market to double and go from $1.5 to $3 million, either the wages are going to have to go up by 100 grand a year, which probably won't happen. The discretionary spending's not helping him at the moment because cost of food, living expenses and that have gone up. Cost of interest has gone up. you'd have to see the interest rate drop down to a specific point. And at that point, you could say, hey, there's going to be a boom here because everyone can afford to pay more money for these type of assets, right? So looking at the fundamentals of the markets, we could go to, I'm not going to say the markets that I'm buying in today, but I'm buying nationally in every single corner of the country. But there's markets out there where the average income might be 150 grand a year, but the price of a house is only 350, 400 grand, and their wage and income would be able to support a mortgage or a purchase price of 800 grand or $1 million. And that's the market that has the potential to go up. So looking at that capital growth, you need to see what market would enable that to happen and what are the fundamentals and what are the key drivers. I just said beforehand, migration to a market, what is driving migrants, opening up to international visitation, right? If we look at Cairns, I'll just use Cairns as an example here. Units in Cairns were picking up for, the cheapest unit I bought in Cairns was $20,000 renting for $300 a week, right? 10 grand a year strata levies, and people spat at it beforehand, right? Those things are now selling for 200 grand. But if we go back and look at what I was picking up on average 3, 5, 7 years ago, they were like $80,000 to $110,000 renting for $250 a week. It was just a decent sort of cash flow. Those things now are $300,000, $350,000 renting for $400 a week. So buying that property today for $350,000, renting for $400 a week, it is not a good investment. I don't suggest to go and buy it. But what caused that market to go up? A lot of demand of people moving to the location, lifestyle reasons predominantly, internal migration to the location, and a lack of building. And that takes me on to the second key driver, right? If there's a demand going to a location and then we've got a need for new dwellings to be built, if you're buying the dwellings that are 200, 100, 300 grand, you can't build them for that. So if you're buying an asset below rebuild cost, that's where the upside is. That's where the fun is. That's where the value is at, because anything that's going to be built to become your competitor, right? Let's say you've got a unit and they're going to build 1 million new units in the area, right? Yeah, that could impact you because people will be like, I want to go to a new unit, not your older unit, right? Some people like the older units because they're smaller, they're well built, all that sort of stuff. But what's most important is if someone was to build a competitive property to yours and that costs $500,000 just to build the unit, and it might cost you $100,000 for the land, that means that any new asset in that location would have to be $600,000-$700,000 today in 2024, right? So if they're building a new asset in the location for $600,000-$700,000 and yours is only $300,000, well, then that has the ability to drag that up to maybe $500,000, right? So you want to look at the intrinsic value of the asset that you're buying, the bricks, the electrical wiring in the wall, the copper pipes in the wall, the labor that it costs to build the property. All those things are very fundamental to be able to determine what could be the potential of a future capital gain in that property. So yeah, lots of variables when looking at deals. If you're trying to hit just the capital gains, the capital growth side of things, that's one thing to look at. If you're looking at the rental aspect of it as well, the similar sort of parameters apply. And the data is very important to look at the data, because if you're looking into a location, you want to see, okay, is there more rentals coming in the market? How long does the rental stay on the market? What is the price of my rental property rent-wise compared to everything else in the market? What are the key drivers that are going to be pushing that up? And some very similar things occur in those markets, whether it's for capital growth or for cash flow. But looking at all the cheapies, if I was to go back, hop in the DeLorean, go back 10 years, go back 15 years ago. If you don't know what a DeLorean is, it's a silver car off Back to the Future where you drive 88 miles an hour and you go back to whatever you want it to be, right? So if we're going to try time travel, hop back in, we would be sitting there thinking, if I was to go back, I'd go back and buy the same things that I bought 10, 15 years ago. And then I'm buying today because that's where I'm seeing the growth. I've seen far further growth in, the affordable property sector than what I have from, the blue chip and all that. And let me tell you guys, it's not that I'm going to buy rats and mice and buy little shitty properties. I've got the really expensive ones. I've got the $5 and the $10 million assets, and I don't talk about them all that often. I've got multiples of those things, large land holdings, but the ones that really impacted my portfolio, helped me with finance and helped me grow exponentially, were the very fundamental properties of buying 150, 200, 250, 300 grand purchase prices renting for $300, $400 a week. And that's the same thing that's worked in the past. It's the same thing that will work in the future. And it's the same thing that's working now. And if we look at a market like we have today, we're seeing markets in the course of a 12-month period, like i.e. right now, after the interest rates have gone crazy, interest rates have gone up. It's made people not be able to afford so much a boom at the top end of town. It's pushed everyone down at a lower purchase price and created a supply and demand issue in the affordable end of the market. And that's the importance of having a recession-proof property portfolio, is having those assets which will perform, not just perform in any market, but outperform in a bad market, right? Awesome stuff. So I've gone on a bit of a rant there about the types of properties, but, looking at, should I go for one with capital growth? Going for one that would have higher cash flow would mean that I won't have capital growth. All my data, all my stats have shown me that the ones with the higher cash flow have actually performed much better as an investment grade asset. So, and that's the other thing as well. As an investor, you want to be buying investment grade assets. You don't want to be buying stuff with emotional feelings to them and all these sorts of things. You can make money out of them, but that's an emotion, right? And it's a bit of, hit and miss and hope and pray, and, it works out. It's good. I see people that say, I bought a property for 500. I bought a property for $1 million and I sold it for 1.4. Great. You made 400 grand, right? You've lost stamp duty. You've lost agent comms. You've lost capital gains tax. You've lost opportunity cost. You had to sell the property because you couldn't hold on to it because your cash flow was so shit. You couldn't hold that property for the next 20 years. You look back and the property's gone from 1 million to 1.4 and then up to $2 million. And you're like, wow, damn, if I had just kept the property, it would have been better. But the problem is that you weren't able to keep the property for the 10 or the 15 years that you required to keep it. And you weren't able to hold on to those capital growth because your cash flow was out of whack and your cash flow position was shit. So if you've got the cash flow position flowing, you can continue to improve your asset base, keep growing your asset base, and hold on to that asset base in perpetuity to be able to see all the potential future growth that you could see in your property. So there's a few things that I'll look at in building a portfolio. But as I said at the start of this podcast, very, very important to work out where you are at today in your portfolio. Do you need capital growth? Do you need cash flow? Do you need a balance of cash flow? If you told me here's a property with, a 20% yield with no capital growth, here's one with 5% yield with a capital growth of X amount, and here's one with a 10% yield, but it also have a X amount of capital growth, I would take that one that's got a good balance of cash flow and growth, because without growth, your portfolio is shit. And there's a lot of people out there that buy these assets that are overinflated. Here's one. I see these ads. I have all these people that are builders and project managers. When you buy a brand new property off the plan, right? It's like buying a brand new car. If you're buying a brand new house, a land package, the person who's selling it to you gets about $50,000 commission for selling you that thing, right? So when people ask me, what's the difference between a buyer's agent and this person that's not charging me? They're getting paid from a developer. You're becoming the consumer, and you're getting taken advantage of, and they're making 50K out of the deal, which you're not aware of, right? But I look at these deals and I see them. People come to me, they're like, sell these things. We can give you these deals and we'll pay you 50,000 commissions. I'm like, just delete them, right? If I had no integrity and no morals, I could probably make a lot of money, eh? But with it, I get these emails and I look at the deals and I look at the numbers of them. And they remind me of deals from 10 years ago. So nowadays they're doing NDIS, right? Where the government's granting you money. It's got super high cash flow and you make lots of money. 10 years ago, there was NRAS, which is the National Rental Affordability Scheme. Kevin 07 and all his mates came out with this great idea that if you subsidize the rent as an investor, you build a new property and you rent it out cheaper by 20%, then you get a rebate from the government of like 6 to 10 grand a year. And that's how all these, suit and tie salespeople sold these type of properties, made lots of money. All those people made lots of money that sold the things, but these people buying the assets, they were sold something that was not a good asset. And I look back now and I pick up those assets that might only be 10 years old for $250,000 that sold for $400,000 10 years ago. And then after a year, the NRAS drops off and the market picks up, and then they're worth $400,000 again. But the poor bastard that bought them overpaid. There was never going to be any capital growth because it was priced at the time that the person bought it based on some sort of incentive that they're getting. So you need to be making sure when you're buying that asset that you're buying something of intrinsic value that is below market value, that is below rebuild cost, has potential for growth, and has a genuine cash flow positive thing. So, I wouldn't touch something if I can see it could have a tremendous cash flow. It could be 50 grand a year positive cash flow. But if I see that it's got a risk element that's attached to it because it's got a potential to fall in price or it's an overpriced asset, I ain't paying overpriced for shit, right? So that's my view on that. So for me, you need a good balance of growth, cash flow, and equity. You can buy properties below market value that have, good growth and good cash flow. If you need help on finding them, the person to call. You can B.Invested, the team. Reach out to the team, 1300 367 925. Email us at admin@binvested.com.au. Watch through all our videos. Educate yourself more because you need both cash flow, growth, and equity. So, catch up soon, guys. Remember to like, subscribe, share, and you can catch us every Thursday on Google Play, Apple Play, Spotify, and YouTube. Catch up soon. Have a great week. Bye for now.
Like Bilal said, man, we're stuck in the matrix. This my advice, don't care if you take it. The dollar back to die, soon to be hyperinflated.